Wall Street is holding its breath after Fed Chair Jerome Powell's latest remarks. So could the central bank's next move on interest rates reshape the entire U.S. economy? I'm Veronica Dudo. Let's find out.
This is In America Today from the Ticker News Studios in New York City.
The Federal Reserve is once again in the spotlight as markets react to Chairman Jerome Powell's latest remarks at the Jackson Hole gathering. Powell acknowledged that sweeping changes in tax, trade, and immigration policy are reshaping the economic landscape. He also signaled that the Fed is carefully weighing how aggressive to be cutting interest rates and balancing the risks of inflation with its mandate for maximum employment. Investors are now bracing for what these signals could mean for the broader economy, business investment, and consumer confidence. Here's Federal Reserve Chairman Jerome.
Here, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be.
For more, I'm joined by Michael Busler, an economist, policy analyst, and professor of finance at Stockton University. Welcome back to the show.
Hi, Veronica. Thanks for having me. It's always my pleasure to be here.
So we heard Federal Reserve Chair Powell's comments. That was just a little snippet. They do seem to have been more cautious than markets potentially expected. What was your biggest takeaway from his speech?
So since June of 2022, the Federal Reserve has had a restrictive monetary policy. What does that mean? It means they keep interest rates relatively high in order to slow the economy and try to get rid of inflation. Recall in June of 2022, inflation had gone up to 9.1%. So now we have the inflation rate down under 3%. It was 2.9 at the beginning of the year. It's down to 2.7 now. And there are many signs that the job market is slowing. Revised data from the Bureau of Labor Statistics indicates that May and June, where we thought we'd added 145,000 jobs, turned out to be only 19,000 jobs and 14,000 jobs. July rebounded a little bit to 73,000 jobs, still relatively weak. So in Jackson Hole, Chair Powell said, we're going to change our focus from looking primarily at interest rates to now looking at inflation rates, rather, to now taking more of a look at the unemployment and the low number of jobs being created. I think the Fed will cut interest rates by 50 basis points in September and probably another 25 in November and December. That'll bring the federal funds rate down a full %. Now, why is that the right thing to do? Most economists will tell you if the federal funds rate is between 3.25% and 3.5%, that's neutral. Above that, you're slowing the economy down, and below that, you're trying to stimulate the economy. The federal funds rate is in the 4.25, 4.3% range now. So it's been very restrictive, and you can't have a restrictive monetary policy when the economy simply is not producing a lot of jobs.
Now, of course, we heard a lot about President Donald Trump's tariffs and the impact that policy might have in all of this. But, here we are talking about jobs. So just kind of what are your thoughts on what we had heard about the tariffs? Maybe what are their impacts now and moving forward?
So if you put a tariff on a product, it adds to the cost of the product and tends to raise the price. How much of the tariff will be passed on to consumers remains to be seen. Most of the tariff deals that President Trump has signed with the UK, with the European Union, with South Korea, these call for a 15% tariff on goods imported into the country from those countries More importantly, it opens up those markets to U.S. manufacturers. Historically, the European Union and other countries charged relatively high tariffs, which meant not the countries didn't buy very many American goods, and we have this huge negative balance of trade. Trump is trying to fix all that. So your original question was, how much will the tariff affect inflation? I think it will affect inflation very little, and President Trump will offset any increase in prices from tariffs by dramatically reducing the cost of energy. Energy prices are already coming down. This year, if you're traveling on Labor Day, the average price of a gallon of gas, it's lower than it's been in the last eight years. So energy prices will fall, and as energy prices fall, that will offset, in my view, any potential increase in inflation due to the tariffs. I think the Federal Reserve is way behind in cutting interest rates. They should have cut them back in May and June. I think they're realizing they're behind the curve now, and that's why I think in September they're going to have a relatively large rate cut.
And we've even seen countries around the world begin those rate cuts, of course, the European Union as well. Now, how are investors interpreting the Fed's signals on interest rates at this point in the economic cycle?
So right after Powell made that statement from Jackson Hole, Wyoming, the stock market had a huge increase. So investors are now fairly certain, and you can't be 100% certain because you don't know until the Federal Reserve meets, but investors are fairly certain that the interest rate cuts will come. When that happens, that will stimulate economic activity. Why? Because now big ticket items like cars and houses become cheaper because the interest rates are lower, mortgage rates will be lower, should have a very stimulative effect on the economy. In addition to that, when business goes to expand and has to use debt, the cost of debt will now come down to them, making it much easier for them to expand. So I think Wall Street is saying if these cuts happen in the fall, 2 or 3 cuts, as I forecast, if that happens, that will tend to have a very stimulative effect on the economy, and we'll start to see GDP grow. And as that happens, corporations become more profitable and stock prices go up. And that's why there's such upward movement in stock prices today, because of the anticipation of better economic activity and higher future profits.
Might there be any risks if the Fed cuts rates too quickly?
So if I'm wrong, and the effect of the tariff policy is to put much higher pressure on inflation, and if I'm wrong and energy prices don't fall, then we're going to have could be a severe or more severe inflationary problem. That's what Chair Powell says has been his reluctance to cut interest rates sooner, because he fears that some events happening may end up pushing prices up higher, tariffs, et cetera, pushing prices up higher. And we just went through, and we still aren't out of it, a severe inflation problem. And he doesn't want to overstimulate the economy if inflation is indeed coming back. That's what his hesitancy is.
How do you see the Fed balancing its dual mandate of maximum employment and stable prices in this environment?
Very difficult. It's always somewhat of a challenge, because anything you do to stimulate the economy to bring the unemployment rate down tends to put upward pressure on prices. And anything you do to slow the economy, to put downward pressure on prices, tends to cause unemployment to go up. What Chair Powell is trying to find is a balance between the two. And as a result of that, he may move a little more slowly than I anticipate. But to find a balance between the two, he'll start cutting interest rates. And as long as inflation doesn't come up, he'll continue to cut interest rates into the future. Most of my colleagues on Wall Street say that they think there'll be 3 interest rate cuts this year and probably about 5 or 6 next year. So that interest rates will be at least 1.5 to 2 points lower than they are today, which will be very good news for the housing market and very good news for the car market and other big ticket items.
And finally, just quickly, how might the Fed's actions impact everyday Americans through mortgages and credit cards and consumer spending?
So as interest rates go down and as the Fed lowers the federal funds rate, driving interest rates down, all interest rates will follow. Mortgage rates today are close to 7%. With the high housing prices and high borrowing costs, a lot of particularly first-time home buyers are forced out of the market. If the mortgage rate drops under 6% and down closer to 5%, that will make homes much more affordable, again, particularly for first-time home buyers, which is a very good thing. As the housing market increases and you sell more houses, there's a rippling effect of that. People buy more draperies and more furniture and more things for their houses. So it tends to have a very strong stimulative effect on the economy. And that's why everybody's looking for lower interest rates really as soon as possible.
Michael Busler, thank you so much for your time today.
Always my pleasure.
This is Ticker. We'll be right back.